Today is Tuesday, September 22nd, 2020. Housing prices are rapidly climbing after having data come out with the median home price up over 11% year over year, right? So now we're at 310,000 and change, almost $311,000 as the median home price as of right now. And like I said, that has risen 11% year over year. So if that's not a form or result of inflation, I don't know what is. And speaking of inflation, while we're at it, lumber prices are actually almost break even for the year when they were up over 50%. They've retraced roughly 40% off its highs, to date. So it's almost break even for the year. That was a direct, the fact that lumber prices actually rose was the direct result of people moving out, out of major metropolitan areas for cheaper cost of living and cheaper construction and cheaper labor. So a lot of people fled, and thus, prices went higher. Prices went higher in lumber and in many different aspects of housing. And not even to mention that, but U.S. household net worth. There's been a lot of jumble about that, but the problem is their net worth hit new record highs, right? So the reason why they hit new record highs is a combination of people. Remember, we talked about this last video, is people are holding and essentially hoarding their dollars, in savings, in banks and pensions, whatever it is. They're just holding it, and that's what the Fed wants. They want dollars taken off the shelf because that'll ultimately, artificially, you could call it, work, if you will, inflation. So, this is not how it sounds, since the top 10% of homeowners own 90% of the stock market, almost 90%, and they're the ones that got rich, not the other 90% of homeowners. What about them? The wealth gap, like I always say, is the largest it's ever been, bigger than major World War periods, and it's the largest it's ever been. And it's only going to get wider because people that are poor now are only going to get poorer, because the amount of permanent jobless claims, jobless losses, are actually on a major roller coaster to the downside. Not to mention that these major top 10% of homeowners that own 90% of the stock market, they are the ones that essentially, not even in matters of controlling asset prices, which they can, but that's not ultimately their goal, because number one, they'll most likely get investigated and arrested by the SEC. But it's in their best incentive to strategize either on a contrarian aspect or in a point of view where you tap into something that's completely untapped. That's what these guys are doing, while the rest of the herd is only compounding in size, right? And it's also actually estimated, right? It's estimated that in the month of August, $300 billion, right? $300 billion in outflows took place in equity mutual funds just in this month alone, in August, this past month. So that's a huge amount of money. That's a huge amount of outflows out of equity markets, because, if you heard about me talking about the PowerShare QQQs, we actually made a post on that if you want to check it out. Some good data on there. The fact that over $1 billion, almost $2 billion in just one day has been actually taken out of the PowerShares in just one day. I believe that was 2 days ago. And if we switch over to the debt markets, fixed income, high yield bond spreads have actually widened the most since June, right? About 25 basis points it's widened. And not even to mention leveraged loan prices, which have also fallen pretty much the most since June. And also today, today we did have, I'm not sure if we had just the 2-year treasury. Obviously, we know that the treasury is slowing down on auction activity on their 9-day schedule or 13-day schedule, whatever. But we know that today was a pretty significant day for the 2-year notes. And the last I checked, they were trading at, I believe, post-auction, 13.6 around there. And the thing that I noticed that was interesting from the auction data is, well, number one, it was a $52 billion auction for 2-year notes. And not even to mention the primary dealers, they grabbed a little over 32 or so percent. They accepted, but the indirect dealers, right, the foreign banks, the foreign central bank, they accepted over 50% of these 2-year notes. So notice how, if you look back maybe half a month to a month ago, maybe even less, if you look into the data, you'll see that these commercial banks have actually been tipping to the long end of the curve. Now they're tipping in increasingly on the the nearer point of the curve. So that's not to say that obviously interest rates are low, and they're going to continue to be low for many, many years, in my opinion, to come. But if you take a look at something like the dollar Libor rate, something short like the 3-month Libor rate, that's also fallen probably to its lowest rate on record. I think the last I checked, it was around 23, 22-ish, maybe 23.4, something like that. But yeah, I mean, it was some pretty crucial things have happened just today throughout foreign exchange and treasury markets that have kind of compelled a conclusion here, a pretty bearish one. Now, we didn't even make the case yet for the US dollar, which I'll pull up on our charts. Right, we've actually been rising to that 94. Let's go back so you guys can see the pattern. That 94, what was prior to these 3, well, 4 technically bounces, we actually saw, that was actually prior support, and this is current resistance now because it's testing, 94 to the upside, not the downside anymore. So this is current resistance, current ascending resistance. But essentially, yeah, it really needs to go over 94 with solid momentum. And the only thing that's going to make this thing squeeze is if we have a roundabout of catalysts that support, the uncertainties of recoveries and COVID. I mean, that's how markets respond with this irrational marketplace filled with irrational buyers and sellers. They, as we've seen since March, as we've seen since February, they respond to catalysts. It's pretty obvious, especially COVID, obviously. As we've seen, COVID is on the rise in many, many countries, including America. I believe the rate was 15% increase in COVID cases in America, over this past month or so. So things aren't, I mean, it's because people are back at school, people are back at work. I mean, what's not to be expected from that? So, the Treasury, meantime, federal government is taking dollars off the market. So we have this constant diverging cycle of debt on top of debt, economic structure, while we have a decreasing amount of dollars, thus suppressing interest rates that are artificially suppressed. And but anyways, I wanted to get over to AIM because we took a trade on this today. And so let's go to intraday on both charts here, go on the 5-minute for both. So AIM came out with a catalyst today. Nothing was moving today as per usual for the past month or so. Nothing has really been moving at all, which shouldn't be a surprise in a recessionary, contracted kind of economy slash market. Although it's a manipulative stock market, it's still one where there's, of course, always arbitrage opportunities. So I thought this might have been one of them. So what I did was the first thing I did was I noticed that AIM tested $3. Okay, so I went back to the 52-week chart and I drew these lines here. I indicated $3, let's start from here. 1, 2, 3, 4, 5, 6, 7, 8. 8 times about more or less it's tested that $3. Most of the time it hasn't even cracked through. It's only managed to break through once, but then it just completely went back under 3, and it's been fading since. So that was my first mistake in terms of analyzing the potential that AIM has in terms of potentially going over 3, which, before taking the trade, I saw it failed to break 3. It cracked below, kind of in a bear flag step ladder formation, and it's been doing that since. But so I noticed that early, and the second I witnessed that weakness, I immediately got out for a cent to 2 cent loss, basically break even. But the point is, I went with my, obviously things didn't pan out as I wanted them to. If things don't pan out for you within the first 5 minutes of your trade, even 10 minutes, depending on the volatility, you should be sure as hell to get out if, especially, things are looking weak in terms of momentum. Because if momentum is not by your side, you're certainly going to take a hit one way or another. So this is essentially the only message I wanted to convey to you all today. Please, if you will, post a like on the video and please hit the subscribe button. It really helps the channel a lot and it would be much appreciated. And obviously, as always, we are not financial advisors, and anything that we say is only for educational purposes only. Do your own due diligence and trade at your own risk. So with that being said, I'd like to thank you all for stopping by and tuning in. We will see you all very soon. Thanks for coming.